Imagine you're standing in a garage looking at two very different machines. On one side, there's a Toyota reliable, familiar, the product of decades spent obsessing over the perfect weld and the most efficient assembly line. On the other, a Tesla, a computer on wheels, born from a manifesto about saving civilization from fossil fuels. The debate between these two giants usually gets bogged down in technical specs. Solid-state batteries versus lithium-ion, or hydrogen fuel cells versus charging stations. But if you look closer, the real friction isn't about the technology. It's about the altitude of the questions they're asking. I recently spent time looking into how these two companies actually think, and the contrast is startling. Toyota started at the ground level. Their foundational question was simple. How do we make a better car for the person standing right in front of us? They built their empire by climbing upward from the factory floor to the Prius, eventually reaching global questions about carbon neutrality. They are the ultimate observers of reality, refusing to move faster than the infrastructure allows. Tesla did the exact opposite. They started at 30,000 feet, with a question that feels almost like science fiction. Can human civilization survive its own energy consumption? From that height, they descended downward, eventually deciding that the car was simply the best capitalistic lever to move the needle on global energy. It's a fascinating inversion. One company is trying to pull the world up into its vision, while the other is trying to ground its grand vision in the reality of the street. But here's the turn. Both of these approaches have created massive, blinding shadows. Toyota's obsession with ground-level truth has left them struggling to tell a story that people can get excited about in the EV era. Meanwhile, Tesla's high-altitude idealism often leaves them crashing into the production hell of basic manufacturing quality. When you see a headline about Toyota lagging or Tesla failing to meet a deadline, it's usually not a mistake of engineering. It's a conflict of altitude. The question is, which perspective actually wins when the rubber meets a rapidly changing road?
And you know what you've hit on there, this conflict of altitude, that's so critical because it isn't just some philosophical difference between an American tech company and this legacy Japanese automaker.
No, it's much deeper than that.
It fundamentally dictates their practical execution. It changes everything, especially when it comes to the big question. How do you find the billions, the immense amounts of capital required for this industrial transition?
Right.
So when we look at the data, we can see how these contrasting corporate identities really manifest in hard metrics. We're talking financial strategy, how they choose to build things, and even how they report their environmental progress.
So that's what we're going to do. We're going to unpack exactly how they fund these competing futures.
And how their core differences in manufacturing philosophy and strategy, you know, Toyota's multi-pathway approach versus Tesla's single-minded energy ecosystem, are really shaping this entire global transition.
Okay, so let's start there. Let's unpack this core difference in their DNA, and I think we have to start on the ground floor with Toyota.
Makes sense.
Because if Tesla's mission feels like this grand existential manifesto, Toyota's is almost, well, it's human. Their mission is producing happiness for all.
Right.
It's all about reliable, accessible transportation. A mission built entirely on a reputation for quality and, of course, that famous, almost sacred Toyota production system, the TPS.
It really is conservative stewardship in its purest form. Their whole identity is just so inextricably grounded in reality. They see mobility as a fundamental human need.
Not a luxury.
Exactly. Not a platform for AI, not a gadget. It's a reliable tool for life. And the strategy that flows from that is necessarily one of gradual transformation. They leverage what they already know.
Which brings us to their multi-pathway approach to electrification.
That's it.
This strategy is fascinating to me because it feels like a direct refusal to follow the current EV monoculture. They are not betting the farm on pure battery electric vehicles, are they?
Not at all. They are hedging. They have BEVs, of course, but they are critically still investing in hybrids, plug-ins, and even fuel cells.
So what's the deep strategic logic there? Why this cautious, multi-pronged attack?
Well, the logic flows directly from that grounded mission. Toyota is looking at the world as it is right now.
Not as we wish it would be.
Precisely. Not how they wish it would be in 5 years. They see regions where the grid is still incredibly carbon intensive. They see huge gaps in charging networks. So their argument, and it's laid out very clearly in the analysis, is that if you focus only on BEVs today, especially in emerging markets or places running on coal.
We might not actually be helping.
You might not be reducing the total vehicle life cycle emissions effectively. The hybrid, in their view, is the perfect transitional technology. It immediately reduces emissions using the infrastructure we already have, while the world catches up on battery supply chains and cleaner electricity.
And it's important to note, this slow and steady approach, it isn't some recent decision. It's deeply, deeply rooted in their history.
Oh, absolutely.
It wasn't just about building a good car. It was about building a good business enterprise that could survive any economic shock.
Exactly right. I mean, you have to look back at the origins of the Toyota production system. Toyota consciously chose to go slow in its early years. We're talking the period between, say, the late 1930s and about 1965.
They were innovating as a business first.
As a business enterprise first, prioritizing stable systems over product speed. And this wasn't an easy lesson. They believed a large sales forecast back in 1950, built ahead of the market, led to a brutal cash crunch. The company nearly collapsed.
Wow.
It had to split into Toyota Motor Sales and Toyota Motors, and this was under intense pressure from Japanese bankers.
So that early near-death experience, that failure to manage what was essentially speculative speed, that must have psychologically conditioned them to be so averse to disruption today.
It forged their entire foundational approach. That trauma, it cemented a culture that prioritized internal cash generation and stable growth above absolutely everything else. It mandated that they develop these rigorous systems, stable production, reliable sales, robust management before scaling.
Speed without stability is just bankruptcy.
They learned that the hard way. It wasn't until 1966 that they were really ready to launch a mass international product like the Corolla, and only because it was backed by these fully elaborated systems. So their DNA, it's fundamentally defined by prioritizing process rigor and corporate resilience. That's the application of Japanese Kaizen and lean manufacturing.
Which explains perfectly why they're so cautious about electrification now. Their grounded thinking forces them to look at the BEV transition through the lens of history and, infrastructure.
Absolutely. Their initial caution on just leaping into pure BEVs, according to all the material, it stems from very practical concerns about the entire ecosystem.
Like the battery supply chain.
The sustainability and ethics of the battery supply chain, for one.
Yeah.
The immediate availability of charging infrastructure. And crucially, the carbon intensity of the electricity grid itself. They are focused on practical, real-world vehicle life cycle emissions.
They're not just asking, does the car emit carbon?
No, they're asking, where did the energy to build and run this car come from? And is that actually better than a hybrid running on gasoline? It's the definition of a company that refuses to operate outside the physical and economic constraints of reality.
Okay, so if Toyota's climbing up from the production floor, Tesla is, as you said, descending from the troposphere. They fundamentally changed the question they're asking.
Completely.
Their mission is a global catalyst to accelerate the world's transition to sustainable energy. This isn't about selling a better car. It's about fixing the global energy structure. The car is just the delivery mechanism.
And that framing, that high altitude, it leads directly to first principles thinking. That's the intellectual engine of Tesla.
So what does that mean in practice? Reasoning from first principles.
It means you ignore analogies. You don't ask, how do we build an electric car like other companies build a combustion engine car? You boil the problem down to physics and economics. What materials do we actually need? What is the minimum energy required? And how can we re-engineer the entire process from scratch?
And we see that logic driving these radical, non-analogy-based innovations, not just in the car, but in the entire business model. The sales model, for instance, just bypassing the traditional dealer network completely.
Yes, because the dealership model is an analogy. It's rooted in the history of combustion engines, which needed constant maintenance. When you apply first principles, you realize the car is a piece of electronics.
Like a phone on wheels.
Pretty much. So why do you need thousands of independent middlemen? You sell direct, you control the software experience, and you service the product as needed. That focus on efficiency and control is essential for their main goal, which is speed.
That focus on first principles is also what drove their massive ecosystem strategy. It's why Tesla doesn't really see itself as a car manufacturer that happens to sell a few batteries.
No, they are an integrated energy company. That strategy stands on 3 interconnected pillars that all feed that big mission. First, eliminate tailpipe emissions with BEVs. Second, reduce fossil fuel dependence through renewable energy generation, like the solar roof. And third, optimize usage with storage solutions like the Powerwall for homes and the huge Megapack for grid stabilization.
It's closed loop.
It creates powerful synergies across their entire business. They realize you can't really solve sustainable transport until you solve sustainable energy generation and storage.
And to make that ecosystem work, they adopted this radical strategy of vertical integration and speed, which is really the antithesis of the Toyota Production System's vast network of suppliers.
It is total control. Vertical integration means controlling the critical components that define their speed. Everything from producing the lithium-ion cells in their gigafactories to developing all their proprietary software to building and operating the supercharger network.
And that control allows them to scale production rapidly.
And to introduce radical innovations like the structural battery pack and the single-piece casting.
Okay, let's pause on those for a second because those are perfect examples of first principles thinking in manufacturing. Why is a structural battery pack or a single-piece casting so important to the mission?
Well, they just reduce complexity and weight, which saves a massive amount of time and money. Traditional car manufacturing involves stamping and welding, hundreds, even thousands of separate pieces to form the body.
Right.
Tesla asked, what if the battery pack itself becomes part of the car's structure? By integrating the pack, they simplify the body, reduce the part count, cut down assembly time, and increase rigidity. Same with the single-piece casting, using these massive machines to cast huge sections of the car in one go. It replaces dozens, maybe hundreds of individual assembly steps.
It's the mechanical manifestation of the mission. Simplify the product to accelerate production.
So while Toyota is focused on Kaizen, that continuous incremental improvement of a very complex system,
Tesla is focused on quantum leaps, what the sources call ludicrous mode acceleration. They choose speed, prioritizing getting the product to market quickly to achieve that mission, even if it means introducing some quality risk.
And this technological dominance isn't just for them, it's a lever for the whole industry. A perfect example is opening their charging connector as the North American Charging Standard, NACS.
Which seemed counterintuitive at the time.
Right, but that move only makes sense if your primary goal is accelerating the world's transition. You make your own infrastructure the standard. It proves they view the industry's success as their own.
So this divergence in their corporate DNA, this grounded rigor versus sky-high speed, it's nowhere more apparent than in how they get their money.
Oh, absolutely.
You have to ask, how do you fund a 30,000-foot vision, and how do you fund a meticulous ground-level transition? It shows the hard choices both companies made to find the billions they needed.
Starting with Toyota, their long history of rigor gave them a massive incumbents advantage in the traditional sustainable finance markets. They didn't have to prove they were trustworthy. They just had to apply their existing environmental governance to the capital markets.
And because of that, they emerged as the definitive leader in structured sustainable debt among automakers.
It's a huge claim, but it's backed by the numbers.
So what does being a leader in structured sustainable debt actually look like for a listener? What does that mean?
It means they're issuing financial instruments, like bonds and loans, that are formally linked to environmental performance, not just, general corporate promises. Since 2014, Toyota has issued over $8 billion in green bonds.
And that money is earmarked for specific green projects.
Exactly. Clean manufacturing, BEV development, things like that. But even more critically, they've committed $4.3 billion in sustainability-linked loans.
Okay, a sustainability-linked loan. That sounds much more rigorous than a standard corporate loan.
It is intensely rigorous. These loans aren't just vague promises. They are explicitly tied to verifiable KUIR reduction key performance indicators, or KPIs. So if Toyota meets their predetermined targets for cutting carbon emissions,
they get a better interest rate.
They might get a favorable adjustment on their interest rate. If they fail, the interest rate might go up. This mechanism forces corporate accountability directly into the financial structure.
And the reason they can do this so well ties right back to that cultural foundation we discussed, the Toyota way.
Absolutely. Their ability to use these rigorous finance markets comes from their existing environmental management systems. Green bonds and these loans, they demand transparency, verification, impact measurement. All of it has to be externally audited.
And Toyota's systems, born from decades of Kaizen and meticulous data collection, were already set up for that.
They already had the infrastructure for accountability in place. It allowed them to scale their green bond issuances efficiently while keeping investor confidence high.
And that confidence translates directly into stakeholder trust, which is a form of capital itself. The sources cite a survey where finance professionals, analysts, academics, they had remarkably high trust in Toyota's ESG reporting. They gave it a mean score of 4.21 out of 5.
That score is massive in the world of ESG reporting. It means stakeholders trust the data, they trust the process, they trust the management, and that trust fundamentally translates to a lower cost of capital for Toyota. It makes their transition cheaper and easier to finance. It's the ultimate reward for their long-term conservative stewardship.
Okay, so if Toyota built its castle on the solid rock of green bonds, where on earth did Tesla find the quicksand money to fund its disruption? It didn't have Toyota's history or infrastructure to access those traditional markets right out of the gate.
Right, and that's where the high-altitude strategy becomes aggressive and unconventional. Tesla's early strategy relied heavily on leveraging environmental regulations themselves as this unusual, high-risk, innovation-driven revenue source.
The sale of regulatory credits.
That's the one.
Let's just talk about the scale of that for a minute, because the number is staggering. Between 2012 and 2023, Tesla generated over $9 billion from selling these credits to competitors.
$9 billion.
How does that even work? Why is that such a genius strategic move?
It's a brilliant exploitation of policy design, mostly based on things like California's zero-emission vehicle or ZEV mandate. It forces automakers to sell a certain number of electric vehicles or buy credits from those who do.
And since Tesla only sells zero-emission vehicles,
they generated far more credits than they needed. So they sold these excess credits to their combustion engine competitors, companies like Fiat Chrysler or General Motors, who couldn't meet the quotas themselves.
So their competitors were literally forced to subsidize Tesla's R&D and scaling costs. It makes it sound less like a passive subsidy and more like a brilliantly executed tax on market inertia.
That's a great way to put it. It provided crucial non-operational cash flow when the company was still struggling to achieve consistent profitability. In 2020, for example, those credit sales peaked. They contributed $1.6 billion to total revenue.
Which was about 5% of their total income that year.
Right. And that $1.6 billion, in many ways, was the difference between profit and loss for a disruptive, rapidly scaling business. It's a mechanism that is perfectly aligned with their disruptive altitude, using external systems to accelerate their internal mission.
And they coupled that regulatory revenue with some very aggressive equity financing. They raised $12 billion in capital in 2020 alone. That takes huge nerve.
Speed requires capital, and the quickest way to raise capital for a growth company is through equity, even if it involves share dilution and volatility. Their financial agility was key to funding the gigafactories they needed to meet those ludicrous mode production goals. They accepted volatility as the cost of speed.
And stakeholders recognize that trade-off. It's reflected in the survey results. While the same finance professionals saw Tesla's strategy as significantly more effective for accelerating overall EV adoption, it scored a 4.15 out of 5.
Which is a very high score for effectiveness.
They also saw it as far riskier, scoring a 3.89, and critically, much less transparent in its ESG reporting. It only scored a 2.94 out of 5.
And that difference between the 4.21 trust score for Toyota and the 2.94 for Tesla, that tells the entire story of their financial altitude. Toyota's goal was risk mitigation and governance rigor. Tesla's was market disruption and speed.
What's fascinating is that the high-risk, high-speed approach, while less transparent, arguably created more immediate positive environmental impact.
It did. It forced rapid scaling, it drove down battery costs, and it compelled their competitors to move. It shows there are multiple ways to fund sustainability, and they're determined not by consensus, but by the company's core identity.
Okay, so when we look at how these massive missions translate into daily operations, the actual manufacturing, the environmental efforts, that altitude difference becomes almost granular. Toyota's commitment is all about detailed environmental stewardship, the meticulous metrics of the ground.
It's holistic and highly documented under their global Toyota Environmental Challenge 2050. That's their version of a civilization-scale manifesto, but it's all grounded in physical metrics. In North America alone, they focus on 4 priority issues that span the entire vehicle lifecycle: carbon, circular economy, water, and biodiversity.
It's the Toyota production system applied to the environment.
That's exactly what it is.
Yeah.
Identifying waste and eliminating it, whether that's scrap steel or unnecessary water use.
And they have extremely specific, measurable goals. They're aiming for carbon neutrality at all North American facilities by 2035. That's Scope 1 and 2 emissions, and across the entire vehicle lifecycle no later than 2050.
And they're making clear, measurable progress. They reduced their absolute Scope 1 and 2 GHG emissions by 32% in North America by fiscal year 2025, compared to 2019 levels. That is a monumental achievement for a company with such vast physical manufacturing plants.
And this isn't just buying offsets.
Oh no, this is hard engineering. Efficiency measures, more on-site renewables like solar arrays on their rooftops, and purchasing more renewable electricity. Achieving a 32% absolute reduction in direct emissions that requires a massive cultural shift and huge capital investment in energy efficiency.
It's hard to do because you're changing embedded physical infrastructure.
Precisely. It demands the painstaking application of Kaizen, those continuous small improvements to energy systems, HVAC, lighting processes, and dozens of different factories. It just underscores their commitment to the ground, mastering the granular truths of industrial operations.
And their focus on water management is another textbook example of this ground-level rigor.
Meticulous. They're moving beyond just simple on-site management to site and watershed water stewardship. They've achieved a 6.7% reduction in water withdrawal per vehicle versus just a few years ago.
How?
By constantly implementing Kaizens. For example, they'll install reverse osmosis systems that treat process water, allowing it to be reused over and over. We're talking about saving tens of millions of gallons a year just through process optimization.
And they aren't just looking inside their own plant gates, they're looking at the external environment, especially in water-stressed regions.
That's right. They know their operational footprint impacts the local watershed. There's one high-risk site in Baja California, Mexico, and even though it has low water intensity per vehicle, the area is a concern. So Toyota has collaborated with organizations like the Nature Conservancy on water restoration projects there.
So their stewardship goes beyond mere compliance.
And into active community engagement. It's accountability at the local ground level.
And this holistic view extends beyond industrial waste to ecology itself, with a focus on biodiversity.
Their goal is harmony with nature. They achieved Wildlife Habitat Council conservation certification at 17 sites, covering over 640 acres. And they're supporting the development of over 20,000 acres of pollinator habitat. This granular, highly accountable reporting on everything, from regulated waste to scrap steel recycled to the specific biodiversity on their land, that's what gives stakeholders that high confidence score.
And in terms of production, despite this multi-pathway strategy, they are still clearly investing heavily in electrification infrastructure.
Yes, the multi-pathway strategy requires simultaneous investment. Recent investments include adapting their huge Kentucky plant for BEV assembly lines and the Indiana plant for battery pack assembly. But crucially, they are also moving their most popular models, like the Camry and Rai V4, to be hybrid or electrified exclusive.
So they're electrifying the mass market immediately.
Even while they maintain their slower, more methodical pace toward pure BEV dominance.
So let's contrast that deep dive into the ground with Tesla's operational philosophy, which is all about scaling an integrated energy ecosystem from the sky down. Their operational effort is fundamentally about rapid product breadth and software integration.
Right. Tesla's operations are designed around the entire sustainable energy equation. They integrate the core vehicles, Model 3, Y, S, X, Cybertruck, Semi, with the energy generation and storage segment, which includes Powerwall, Megapack, and Solar Roof. And the critical differentiator here, the thing that allows their speed, is software control and vertical integration.
The vehicles themselves are the famous computers on wheels, relying on sophisticated, internally developed software for everything from performance and safety to infotainment.
And that software integration is pervasive. It allows for continuous product improvement through regular over-the-air updates, which is a manufacturing advantage no traditional automaker can easily replicate. But it doesn't stop with the car. They also develop the sophisticated software needed for remotely controlling and dispatching their stationary energy storage systems, like the Megapack.
So they can function as a utility operator.
Exactly. Optimizing the flow of renewable energy across vast grids. This high-altitude view means they see their products as connected, optimizing nodes in a giant global energy system.
And the physical infrastructure they control, the supercharger network, is integral to that entire system.
They're building the infrastructure, increasingly powering it with renewables, and then opening it up as NACS to accelerate the macro mission. That decision to open NACS is maybe the purest operational expression of their mission. It costs them some short-term advantage, but it forces the entire industry to adopt their standard, dramatically accelerating the growth of the charging infrastructure that the whole EV market needs to succeed.
And their speed of expansion also relies significantly on leveraging government programs and incentives to reduce costs and attract capital.
Absolutely. The speed of ludicrous mode growth would be impossible without policy support. They rely heavily on programs like the Inflation Reduction Act, the IRA tax credits, which provide incentives for manufacturing batteries and EVs here in the U.S.
And they also use complex local agreements.
Oh, yeah. For instance, at Gigafactory New York, Tesla has lease obligations tied directly to meeting specific employment and spending targets.
So if they fail to meet those metrics, they face penalties.
Right. And similarly, they have tax agreements in Nevada and grants in Texas tied to property taxes paid. These agreements effectively reduce their initial capital outlay and attract investment, but they also impose high-stakes operational constraints tied to rapid growth. It's a high-leverage way to build an empire quickly, a huge divergence from Toyota's self-funded internal growth model.
So the paths of the grounded incumbent and the sky-high disruptor are defined by their successes, but they are also defined by the massive blinding risks embedded in their core philosophies.
For sure, if you're operating at 30,000 feet, the risks are fundamentally different from those on the factory floor. The risks for Tesla are concentrated in volatility, reputation, and dependence.
That rapid scaling strategy must expose them to constant production disruptions.
And unexpected costs. They have to forecast these incredibly complex supply chains in a way that a company prioritizing control, like Toyota, just doesn't.
And you can see that volatility on the public market. Tesla's stock price has had these extreme fluctuations. The sources show a 52-week range swinging from a high of over $480 to a low of under $140. That's massive financial whiplash.
It reflects the market's high uncertainty about their pace of innovation, their manufacturing stability, and, critically, their governance structure. It demands a much higher risk tolerance from investors. Furthermore, the sources highlight a unique risk for Tesla that few established companies face: key personnel dependency.
They are highly dependent on the services and vision of their CEO.
Yes, and this is a financial and operational concentration of risk. He holds management positions at multiple other ventures, SpaceX, X Corp. His time and focus are fragmented.
And the financial structure around that dependency adds another layer of instability.
Precisely. His personal financial arrangements, where shares of Tesla stock are pledged to secure personal loans, mean that if the stock price were to decline substantially, he might be forced to sell a significant number of shares, potentially causing the price to decline even further. That kind of intertwined financial risk is almost unheard of for a company of Tesla's size.
And beyond the financial volatility, their disruptive approach introduces continuous reputation and litigation risk.
Operating at that speed means cutting corners, or at least being perceived as cutting corners. The company faces continuous scrutiny and litigation tied to high-profile issues like their autopilot and full self-driving technology. They also deal with frequent internal issues, alleged discrimination lawsuits, shareholder lawsuits.
It's hard to maintain public credibility when you're under that kind of constant media spotlight.
And moving at a speed that sometimes outruns the regulatory frameworks.
Okay, so let's land back on the ground and look at the risks of only operating on the factory floor. In contrast to Tesla, Toyota's risk is often passive. It's the risk of the strategy lag. They are fiscally stable, they have the governance rigor, but their cautious approach to pure BEVs risks them missing the curve. If global electrification accelerates faster than their multi-pathway strategy can manage.
They risk being perceived as too slow or technologically behind just because their culture demands perfection before volume. And we see that practical pressure in the financial analysis. It recommends that Toyota needs to accelerate its BEV-focused financing to match the commitments they've already made to hybrids.
Yeah.
The capital markets are signaling your hybrid strategy is great, but your BEV strategy needs more aggressive funding.
They're victims of their own meticulousness. They struggle to accelerate because their culture, the Toyota way, is designed to move systematically, get the job done right the first time.
Which brings us to the ultimate conflict here. How do you reconcile the slow, systematic approach of the Toyota way with the ludicrous mode speed demanded by a global climate crisis? The cultures fundamentally conflict, and that cultural inertia resists the speed of Silicon Valley's disruptive model.
And there's even historical evidence of this cultural dissonance. The sources reference a historical partnership between them, the project to produce an all-electric RAV4.
That project is the perfect anecdote for a culture clash. It ended with both companies deciding to, quote, admire each other from a distance. The disruption model, move fast, break things, iterate in production, is anathema to the methodical rigor of TPS.
Toyota sees that as generating unacceptable waste.
And Tesla sees Toyota's approach as being too slow to address the civilizational challenge.
So the ultimate challenge is cross-learning. Toyota needs to absorb some of Tesla's boldness and willingness to reason from first principles.
While Tesla desperately needs Toyota's stability, manufacturing accountability, and governance rigor, without sacrificing its core disruptive DNA.
I think we've really mapped the terrain here. We've seen that Toyota built an empire by mastering the granular truths of manufacturing and risk management, effectively climbing up to the mission.
While Tesla started with the enormous mission and descended, using speed and technology as its primary levers.
And the friction between them is, well, it's essential to the future of the industry.
It is. The core takeaway from all this material is that sustainable finance and operational success are not about compliance or technology alone. They are intensely shaped by corporate identity and the fundamental questions asked at the very beginning. The global transition demands both mission-driven urgency and meticulous, grounded execution.
The company that ultimately wins the global race for sustainable transport will not be the one with the best battery or the biggest vision, but the one that most successfully internalizes the other's core philosophy, grounding its grand strategy in production mastery, or elevating its reliable processes with civilization-scale urgency.